Welcome to DebtCircle Key Roundups. I am Vijendra.
And I am Leela.
We've got some critical updates in the world of corporate debt and credit ratings. On the flip side, VIP Industries has just seen its credit rating downgraded to CRISIL A- with a negative outlook. We'll dive into what might be driving this downgrade.
Absolutely, Vijendra. First up, we are looking at Credit Access Grameen, which has successfully raised 425 crore rupees through a private placement of non-convertible debentures. This is a significant move for their financing strategy. And lastly, Som Distilleries has also faced a ratings downgrade, this time amid the suspension of operations at their Bhopal plant. We'll explore the implications of these developments for investors and stakeholders alike. So, stay tuned as we unpack all these stories and their impact on the debt market right here on the DebtCircle podcast.
Credit Access Grameen raised Rs 425 crore through private placement of non-convertible debentures, split into two tranches. The first tranche was Rs 325 crore at a fixed coupon of 9.25% for 2 years, including a green shoe option of Rs 125 crore. This capital raise strengthens their diversified funding base, supporting their 2028 funding goals. Institutional investors like Sundaram Finance and Julius Baer Capital backing this round reflects strong market confidence in their creditworthiness.
The second tranche was a bilateral deal with Bajaj Finance Limited for 100 crore rupees at a floating coupon of 9.15%, also for 2 years. This mix shows their strategy to balance fixed and floating costs amid market conditions. With over 2,200 branches in 16 states, this funding positions Credit Access Grameen well against peers. Investors should watch their cost of funds and asset quality to gauge how this impacts future growth and financial stability.
CRISIL downgraded VIP Industries' long-term credit rating from CRISIL A with negative outlook to CRISIL A- with negative outlook, impacting bank loans worth Rs 464 crore. The rating change signals increased credit risk, affecting VIP's standing in the consumer durable sector and its ability to secure favorable funding.
This downgrade reflects financial stress and raises borrowing costs. The negative outlook warns of possible further rating drops if performance doesn't improve. Investors should watch upcoming financial results carefully. VIP's response will be key to stabilizing its credit profile and regaining lender confidence.
This downgrade reflects financial stress and raises borrowing costs. The negative outlook warns of possible further rating drops if performance doesn't improve. Investors should watch upcoming financial results carefully. VIP's response will be key to stabilizing its credit profile and regaining lender confidence.
The market sees this as a warning. The plant shutdown disrupts revenue and cash flow, raising doubts about Som's debt servicing ability. Lenders might tighten financing, affecting the company's liquidity and investment appeal. Investors should track updates closely. Infomeric's future outlook will hinge on operational recovery, which directly impacts Som's credit risk and access to capital going forward.
Utkarsh Small Finance Bank is selling stressed loans totaling Rs 726.83 crore using the Swiss challenge method divided into 3 pools: unsecured microfinance loans of Rs 507.42 crore and Rs 143.12 crore, plus secured commercial vehicle loans of Rs 76.29 crore. The sale is as is where is without recourse, meaning the bank avoids liability after transfer. However, the recovery value may be below the total stressed amount, potentially impacting profitability and capital recovery.
This sale by June 29, 2026 helps improve asset quality by offloading non-performing assets. The Swiss challenge invites higher bids, maximizing recovery, a common strategy among Indian banks to strengthen balance sheets and manage risk. Market watchers should track the bids closely. The final recovery will reveal how effective Utkarsh's asset management is and indicate future financial performance, aligning with usual Indian banking practices for managing stressed assets.
CARE Ratings upgraded Kamdenu Limited's ISO rating from CARE A stable to CARE A plus stable, citing improved operational efficiency and fiscal year 2026 performance. This signals a stronger credit profile and lower credit risk for the company. However, investors must monitor ongoing financial results and market conditions. The rating is based on abridged fiscal year 2026 data, and future debt or market changes could impact the credit rating.
This upgrade should ease Kamdhenu Limited's access to debt financing at better terms. In the competitive building materials sector, especially steel and TMT bars, a higher rating enhances lender confidence and could give Kamdhenu Limited an edge over peers with lower ratings. True, maintaining vigilance is essential for debt professionals. While the upgrade is positive, it remains an opinion subject to change with Kamdhenu Limited's evolving business performance and external factors.
IIFL Finance plans to raise up to rupees 10,000 crore through equity or other securities, possibly in multiple tranches. The method could be public issues, rights issues, preferential allotments, private placements, or qualified institutional placements depending on market conditions. Additionally, the board doubled the global medium-term notes program limit from $1 billion to $2 billion, increasing overseas debt access, and raised domestic borrowing and security limits from rupees 60,000 crore to rupees 75,000 crore. Leadership also changed with a new chief financial officer starting June 27, bringing over 20 years of experience from leading finance and compliance roles in major companies.
This flexible approach shows IIFL's intent to strengthen capital amid varying market scenarios, which could enhance liquidity and support growth opportunities in the non-banking sector. Expanding these limits gives IIFL more funding flexibility, crucial for sustaining lending and operations, especially as regulatory environments tighten for non-banking financial companies. Despite this strategic leadership move, the market reacted with a 3.06% share price drop to rupees 509.10 on June 25, reflecting cautious investor sentiment.
Anchor investors, including Ares Management and Deutsche Bank, agreed to extend the loan-to-value ratio relaxation on Shapoorji Pallonji bonds until September 30th. This extension supports their planned refinancing of approximately rupees 22,000 crore, led by Deutsche Bank, aiming to complete it by mid-July. Also, Goswami Infratech investors agreed to extend rupees 14,300 crore of bonds by 1 month to July 31st, with a consent fee raised to 30 basis points. Discussion centered on clarifying loan-to-value covenants rather than Tata Sons IPO timing.
This is significant as it allows the group to manage upcoming debt maturities smoothly. Market confidence improved after the Reserve Bank of India's regulatory clarity on non-bank financial companies, which boosted expectations for a Tata Sons public listing, though no timeline is set. The higher consent fee indicates cautious investor sentiment, emphasizing the importance of transparency on collateral and deleveraging plans, even as formal commitments on Tata Sons stake monetization remain pending.
Indian issuers like State Bank of India and Bank of Baroda have paused dollar bond plans due to investor demands for higher yields, with spreads widening beyond previous levels because of anticipated bond supply increases. Meanwhile, entities like the National Bank for Financing Infrastructure and Development aim to raise $1 billion via foreign currency loans, expecting loan pricing around 6.5 to 7% per annum.
This pause reflects market tension. Investors want better returns amid abundant supply, while issuers avoid overpaying, even with Reserve Bank of India concessions in place. Plus, the Reserve Bank of India's special swap window offers cheaper hedging alternatives at 1.5% per annum, making foreign currency loans more attractive than pressured dollar bond market.
Indian fintechs are using the Gujarat International Finance Tech City or GIFT City to expand cross-border payments. The International Financial Services Centers Authority issues a payment service provider license, enabling advanced services like capital market transactions, which the Reserve Bank of India's regime restricts. Decentro, holding a full license, expects revenue near $1 million by the end of 2027 from its GIFT City operations. This underscores the commercial potential of unrestricted cross-border fintech services.
That license opens new avenues for fintechs, allowing them to process multi-currency payments and treasury functions. This regulatory flexibility is attracting firms like Skydo and Xflow, signaling GIFT City's growing role as a global fintech hub. The license also supports innovations like replicating India's domestic recurring debit system for international payments, crucial for trade finance. Overall, GIFT City is positioning Indian fintechs for scalable global expansion beyond current regulatory limits.
RAC Ceramics India raised rupees 200 crore through senior secured rated listed redeemable non-convertible debentures via private placement to fund corporate and capital expenditure. The legal advisory role was handled by JSA advocates and solicitors, ensuring full compliance and smooth execution across multiple jurisdictions.
This move strengthens their balance sheet and supports growth, reflecting confidence in their operations as a wholly owned subsidiary of RAK Ceramics PJSC. Such thorough legal support is crucial for cross-border financing, enabling timely closure and reducing regulatory risks for the company.
Nilsi India Limited issued commercial paper worth rupees 500 crore on June 24, 2026 to manage short-term funding needs. This consisted of 10,000 instruments, each with a face value of rupees 5 lakh. The disclosure complied with the Securities and Exchange Board of India regulations, ensuring transparency by informing the National Stock Exchange and Bombay Stock Exchange promptly on June 25, 2026.
This move reflects typical corporate strategy to maintain liquidity efficiently. Given NLC India's status as a Navratna public sector enterprise, this issuance signals disciplined capital management in the mining and power sectors. Such regulatory compliance maintains investor confidence, especially for a company headquartered in Chennai and operating from Neyveli, Tamil Nadu, reinforcing its commitment to prudent financial practices.
Saman Capital paid interest totaling Rs 163.07 crore on secured redeemable non-convertible debentures across 37 series between June 18th and 25th, 2026, well before maturity dates in late June. Payments covered multiple ISINs and were phased to precede due dates by 1 to 2 days, emphasizing the company's commitment to proactive debt management.
Early payments signal strong liquidity and financial discipline, reassuring investors and supporting market confidence given the timely servicing of obligations under regulatory compliance. This ahead-of-schedule approach aligns with regulatory mandates and enhances Sammaan Capital's credibility in the debt market.
Goldcard Jewels Limited seeks shareholder approval for a Rs 100 crore loan to Lakshmi Goldorna House Limited at 11% per annum interest with a tenure of 2 years. This loan equals 85.24% of Goldcard's audited consolidated turnover for financial year 2025 to 2026. The loan will be unsecured, funded from retained earnings and securities premium, and can be dispersed in multiple tranches.
Given the loan's size and unsecured nature, it's a significant related party transaction requiring a special resolution under the Companies Act 2013. The electronic postal ballot runs from June 27th to July 26, 2026, ensuring broad shareholder participation remotely. That wraps up today's roundup here on the DebtCircle podcast. Thanks for tuning in.